Hi, I'm Jarrad Brown, Australian expat financial planner based here in Singapore. Welcome to my video series and thank you for tuning in. Today I'd like to cover a relatively simple topic, but a very common question that I'm asked by Australians all over the world. And that is, how do I create the most tax efficient retirement income as I possibly can? What should I think about? Is it super? Is it property? Is it shares? Is it other investments? What do I do? And where do I get started? So in this video today, we're going to look at some of the common holding structures and what you might want to consider. So let's dive right in. Now the first one is superannuation. Anybody who's worked in Australia previously will no doubt have some super, and hopefully you know where it is. If you don't already, you can check out our previous video on how to find your lost super and how to go about consolidating it. You need to set up a MyGov account, set up the MyGov code generator, particularly if you're living offshore and don't have an Aussie number. But you can follow more about that and hear more about that in the other video. If we look at superannuation as a tax efficient structure, it's important to realise that when you retire, when you reach a condition of release, you can have up to, under the current rules, $1.7 million each person in your super to convert into pension phase. That means that capital gains, dividends, distributions from your pension are now tax-free. Now that 1.7 million is set to be indexed over the next few years. Bear in mind that may be subject to change depending on how the next election goes and who happens to be in power in Australia when you do actually retire. So let's just say we have the current rules, we have $3.4 million in our super fund, and we want to draw 5% of that balance every year. That gives us $170,000 of tax-free income every single year, just shy of $15,000 a month based on today's calculations. Now, for many people, that's going to be sufficient and you don't need to worry about too much else. However, it's very important to bear in mind that to access super, you need to have reached your preservation age, which for most people is going to be 60 and retired, or beyond the age of 65. So if you're looking to retire early, you need to start to explore some other options of how you're going to generate that income before the super can kick in. So very important to do your homework here, seek advice from a qualified Australian financial planner, and make sure that your super is working for you. The second common asset class loved by most Australians is residential and even commercial property. Our residential property market, based on the latest CoreLogic data, is valued at about $9.8 trillion. It is one of the largest of many developed nations and commonly forms part of many Australian expat portfolios. Now, rental income, if that property is owned in your own name, is going to remain taxable even in retirement. That's not to say that property is bad. Often rental income can be very consistent, very reliable. Typically it's linked to inflation, so you might see that steady increase over time. But it's very important to bear in mind that that's going to form part of your taxable income. If you're retired in Australia, you'll have your tax-free allowance, $18,000 to $19,000, again, depending on the limits at the time. So maybe the rental income will form part of your taxable income and the rest will come from tax-free sources. Very important also with property, have a look at any allowable deductions that you can claim. That might be your maintenance, interest that you paid on the loans, repairs to the property, management fees, strata, council rates, water rates, land tax, any tax credits that you've accumulated over time, you may be able to utilise those to offset that tax in retirement. Again, very important to seek tax advice here from a qualified accountant. The third common option is direct shares or direct investments in bonds or ETFs or managed funds. Now, under the current rules, we have what is called the franking credit system or the imputation credit system in Australia, which effectively is a tax equalisation scheme. If a company pays 30% tax in Australia, which is the current corporate tax rate, and then pays us a dividend as a shareholder in that company, then naturally we shouldn't have to pay that 30% tax again. Now, bear in mind here, whilst the franking credit system is particularly attractive at the moment, it has been hinted, particularly by the Labor Party recently, and many times over previous years that this system would be changed and potentially even removed. So if you're relying wholly and solely on this one system to provide for your retirement forever, it may be time to start thinking about what if it all goes wrong. What if those dividends start to become taxable and the franking credits don't apply? Would you be okay? Would you need more income? So certainly an important one to consider. The fourth one is any interest that you're earning on cash in the bank. Now, it's a bit of a misnomer these days. Who on earth is earning interest on their savings? I think you'd be very hard pressed to be earning more than 50 basis points or 0.5% in today's current environment. Naturally, we expect that interest rates are going to increase over the years to come, but just bear in mind again, a little bit like capital gains or dividends or rental income, that is going to form part of your taxable income. Obviously, if that cash is held inside your super and becomes part of your pension account, that would be a different story. But if it's in your own name, interest that you earn needs to be declared and would form part of your taxable income. The final two sources that I want to highlight for you are insurance policy distributions or insurance bond distributions and distributions from your trust. Now that might be a family trust, a bloodline trust, an unlisted unit trust. The list goes on, and very important to seek tax advice when you're considering how that's going to be taxed. It may give you more control on how and when and to whom those distributions are sent to and transferred to, but very important to speak to your accountant if most of your investments that are going to provide your retirement income are held inside a trust. If you hold an insurance-linked policy, so investments inside an insurance fund, it's very important to review with your advisor or with your insurer whether it will be tax-free or tax-exempt in Australia or not. There are some that generally will be, again, important to seek tax advice here, whilst there are other structures that are far less certain. So again, if you're planning to rely completely on distributions from that insurance policy, speak to your advisor and make sure that they are going to be as tax efficient as you expect. I hope that gives you a bit of guidance on some of the common structures, some of the common investments when it comes to planning for our retirement. Obviously, if you have any questions or any vehicles or structures that I haven't covered in this video, please drop me a note. Feel free to contact me directly. Drop a question in the comments. Always happy to speak to you and happy to answer any questions. Thank you very much for tuning into the video. Please remember to subscribe, and I look forward to seeing you next time.